In my career, I've never seen this interloper come about. Can't even remember the last time something like that even happened. I think it's pretty clear, like Pfizer is very close to the government, very close to the Trump administration. They were the first to jump on to this Trump RX idea. They've made a concerted effort to be in the good graces of the current administration. And it would seem, if you're connecting the dots, that that relationship benefited them in the end. All right, everybody, welcome back to Drug Dealing. This is episode 7, and we have a great episode for you today, talking about a very interesting topic. Some would say these are the most the most interesting 2 letters in all of biopharma, M&A. So today is a bit of a deep dive into M&A. We've collected a lot of data stretching back from the last 10 years or so, and also double clicking into all the deals that we've seen throughout this year. This will be an ongoing topic that we touch on throughout the podcast. But today we're trying to zoom out a little bit, tease out some interesting trends, and maybe double click into some interesting deals that occurred, and specifically talk about one sort of very unprecedented situation that we've seen, which is the Pfizer-Metsera deal, with kind of Novo being this very interesting interloper. So that's the topic for today, and hopefully this is something you enjoy. Obviously, M&A is super important to just how the biopharma sector is set up, right? We small biotechs love to get acquired. The acquisitions kind of help create more capital that goes back into innovation that can fund new drugs. And so as we've started to see, it felt like an interesting increase in amount of M&A that's happening, especially from big pharma players. Kenny and I wanted to double click into this and see, does the data actually bear this out? And what other trends should we keep our audience mindful of as we finish out the year?
Yeah, thanks, Shivu, for the opening. I like some of the data that we pulled together. I think it's really interesting. There have been some shifts and some changes that are notable as folks in the space, or maybe folks who monitor the space, would want to understand a little more about. To your point, I think it's good to stay focused on the latest trends and some of those trends and what they could mean, including the big dramatic bidding war that we saw between the players that you mentioned for Metsera. So I'm glad that we're gonna dig into that a little bit. But there's also, to give the audience a teaser of what's to come in just a few moments. There's been more use of certain levers or mechanisms in M&A for biopharma that perhaps are at a higher rate than we've seen before. And so before we even get to the beautiful content, I wanted to just share something I've noticed in the analysis that we're going to have in a little bit is this idea of CVRs. What are CVRs? And we're seeing more of it. And I wanted to just walk people through what that means up front in biopharma M&A. It's not exclusive to healthcare. And so I'm using an Investopedia definition, which is all of finance. And so CVRs are contingent value rights, and they're contractual agreements granted to shareholders during mergers, acquisitions, restructurings, and they offer potential compensation for a future event, something along the lines of some kind of a regulatory approval, some milestone related to performance, or something regarded on the timeline that's really important to the acquirer or the target. So CVRs, they basically help bridge valuation gaps. If by chance a pharma company is buying a drug company and saying, look, you're not yet approved, so we're willing to take the risk to buy you for this price right now. However, we are a for-profit organization. The approval matters because of revenue generation and getting to patients. You'll get a CVR, a contingent value right, of an additional value on top of what we're paying you for upfront right now if you reach that performance. And so I think it's good for people to know that these are used regularly in pharma and biotech deals. Our analysis today could be about the whole sector, but Shivu, what I think is most important for folks to understand is what really sets trends are the bigger players. One biotech taking out another, I think, is an interesting nuance, of course. But when the big players who have the most durable cash flows and the greatest power and, frankly, the greatest influence make trends, I think those are the ones we should pay attention to. So, a lot of our lens today is CVRs through the focus of pharma. And as I mentioned, they help bridge the value gap. If I'm getting acquired, but I feel the acquirer is not giving me full value. I may be okay with the CVR saying, fine, I know I'm going to perform. So I'll get this additional value on the other side. But from the acquirer's perspective, they may not be as bullish. They'll assign a percent risk to my ability to execute. And they might say, okay, I'm okay with that. And if it happens, hey, it's a win for us and I pay a little more for it. And if it doesn't, they can go to their shareholders and say, we were concerned about that risk and we had a hedge in place against it. So to round out the CVR topic, I mentioned that they're event driven. They could be financial driven. Maybe some companies, if they hit a certain sales number, the acquirer says, okay, you've done well. You deserve more payout, essentially. And there could be one more scenario of a CVR, Shivu, litigation. If by chance there's some IP issue or something along those lines, an acquirer might want a CVR tied to that just to make sure they're clear on the other side. So that's my speech on CVRs because we're going to get into that now, but I wanted people to know up front.
Yeah, I mean, my simple understanding of it is, oftentimes in deals that get announced for, partnerships and collaborations, right? Usually it's a big company partnering with a small company for their lead asset or, a collection of assets. Oftentimes there's milestone payments attached to progress of those assets after they cross certain de-risking thresholds, typically moving to a higher phase of development, moving through the regulatory system, getting approvals, et cetera. And so this is kind of a set of milestone payments that track with the risk of a company getting acquired, right? So it's almost milestone payments, but post acquisition in a lot of ways. So where should we start, Kenny? Should we start with the all the deals from 2025? We can pull up that chart and go
I
there.
like that chart. Yeah, I thought that one really highlights a nice clear picture. And remind me, Shivu, as you pull that up, data are as of today, right? I think
As of today, yeah. So we should mention that. Thank you for doing that. So we're recording this, a little inside baseball here, but we're recording this on Friday, November 14th. This is actually today, Merck, obviously, one of the biggest acquirers in our space, just announced that they're acquiring a small biotech called Cidara Therapeutics, who has a drug for influenza A and influenza B for $9.2 billion, which is a really big deal, which is pretty sizable amount of money, especially given that I think yesterday when you and I were kind of prepping for the pod, I think Cidara shares closed at like 3.3 billion. So this
yes.
is, 200% more than that value. So pretty significant deal. So all of that to say it's a really interesting multiple, but also that, this data is updated as of, the latest. So hopefully nothing happens, nothing significant happens before we post this for the masses.
I think it also goes to show, Shivu, we like this so much. We're happy to crunch live. And that's very much what this was. So I like this output. And so we have reverse chronological order. So nearest in time, as you scroll down, and you don't have to scroll down through all of it, but I just think it starts to highlight where we are. So we have Merck Sadar, as you mentioned. There were some smaller ones, Day One and Mersana. And you'll see that we have this column in the center that highlights CVRs. And what was it, Shivu? A few days ago, we had the conversation of, does it seem like we have more CVRs today than in the
Yeah.
past? Because that column, I don't recall, I've seen various cuts. I don't recall CVRs being as prevalent before. And so as you go through these, you'll see some of the things that some of the transactions you might recall. One we're going to go into a little bit here more of is obviously the Pfizer deal, but we also have one there, October 9th. Just below that, I wanted to highlight Novo and Acero. So that's a 4.7 billion transaction with a CVR value of about 500 million. So a little more than 10%. And I wanted to highlight what exactly does a CVR mean in this space? We picked this because I do have a history in MASH, metabolic disease, and I was familiar with Acaro. I hadn't followed them for a few years, but did follow FGF21 analog development for a long time.
A lot
And
of
I thought this was
ex-colleagues at that company too.
we do. We have several friends, and frankly, I'm happy to see that doing well because MASH patients need something. And so FGF21 could be very promising for them. And you'll see on this table as you scroll down, we don't have to get through all of it yet, but there's been a few NASH MASH deals. I still say NASH because that's the old phrasing, but there have been a few MASH deals. And frankly, the last three have been all on the same target, FGF21 analogs. And so I just wanted to remind people of a live example of CVR. And so October 9th, we're just about a month ago, Novo comes in, acquires Acaro, 4.7 billion, $54 a share up front, but they have an additional payment in the form of a CVR, 500 million. And so what is this? And so this is a non-transferable CVR, and for shareholders at US dollars, there is an additional payout of that amount upon achievement of a specific regulatory milestone. What is that milestone? Novo defined it with Acaro as full US regulatory approval of the drug efruxifermin for the treatment of compensated cirrhosis, so that's stage 4, due to metabolic associated steatohepatitis, MASH, on or before June 30, 2031. And so I think this is important because full regulatory approval, there's a little caveat there. The initial MASH studies are based on conditional approval, subpart H, based off surrogate endpoints that are likely to show positive outcomes results. And when and if those positive outcomes materialize, the drug gets full approval and it's essentially final. Novo is essentially saying, we don't want to pay for all that up front. However, in the scenario that you do get that full approval, an additional CVR awaits you. Now, 2031 is quite a ways away. And those who are on the outside or who are thinking about the valuation metrics of this deal, what they could do is assign a risk and time value to that 500 million, assuming, that outcomes is achieved, there's a certain percent you could assign to that. And then the time value of 2031 to now, it's a little over 5 years approximately. And that's an event driven study. So there's probably some hedging in there. Could be earlier. You could assign like what the probability of what that CVR is worth today. And then you would add that to your 4.7 billion. And that's approximately the total deal value. So that is an example of a CVR from an acquirer saying, we don't want the full risk right now, but we're going to pay it down the road if it comes to fruition. And Shivu, while we're on the topic of risk, I do think it's worth mentioning as we go through this data, we have some bar charts for us, for everyone to see that it seems like pharma is a bit more cautious lately on risk. And what does this mean for overall deals? We're going to highlight for you, but I think it's just worth mentioning, and that's a live example.
Yeah, I think that's great. I mean, there's more we can say about this too, and we might do it in a future call. But some companies, what you notice over the course of this year probably didn't do a ton of deals that required a CVR. I mean, Merck did a lot of big deals this year. Obviously, they did this Verona deal as well for 10 billion. We talked about the deal this morning with Sidara, but they had multiple other large acquisitions that they did, typically for late stage companies. And so, the context of M&A for the biggest acquirers in our space, the context matters a lot as well. And obviously like a really overarching piece of context is what is the macro environment, right, with there being scarce amounts of capital, higher interest rates which impact these types of things, but also kind of on an individual basis, certain companies like BMS and Merck have really big patent cliffs coming up for their biggest products, right? Especially Keytruda and Opdivo, their PD-1 cancer drugs, which I think go generic in 2028. So a lot of the activity that we're seeing too, especially with companies buying later stage companies, later stage biotechs, is to kind of fill in those, get ahead and try and fill in those forthcoming revenue gaps once their biggest products come off patent.
I think that's a good point that I think it's pretty well known that this patent cliff has been coming for years and it's urging a lot of major players to transact. Do you think it makes sense, Shivu, to move into the bar charts, or was there anything else on these tables you wanted to explain?
Nothing else on the tables. I'll just say that we every every time M&A comes up and patent cliffs come up, we always hear the patent cliff stuff. Any analyst report you see, I mean, this is going back the last few years, right? So like you're saying, people have been talking about, oh, this patent cliff's coming up for Merck and BMS, and even I think Amgen even has some big patent cliffs coming up as well. Pfizer too, right, with Eliquis and that kind of stuff. So, I mean, it always comes up, and it always is an explanation for where pharma is trying to, refill their coffers with interesting assets. And it might not go away, right, until we actually hit that patent cliff, right? I never get the sense, when is enough enough? When are investors happy with enough M&A? And I feel like it's kind of one of those things. It's kind of like pizza. You can, if you have the appetite for it, pizza's great. You can just eat as much pizza as you want. I think investors too always love seeing M&A, right? Like, when is enough M&A enough? And I don't know. I've never encountered someone from like sell side or buy side that goes, "Oh yeah, this company X has done enough M&A. I think they're good. They don't need to do any more. They just need to buckle down and execute."
No, and I think this actually goes back. It reminds me. It's a really good point you mentioned. It reminds me of one of our initial calls. Does pharma avoid cures? This is actually one of the answers to why it doesn't. It cannot. Because part of the reason why investors always want so much M&A and activity, if you can't do it organically, internally rather, they want you to do it externally and transact with other entities. That's because the space is so competitive and dynamic. You must constantly adjust and pivot. And I remember doing an analysis at a previous company where we were looking at some of the biggest pharma players out there, and we did an analysis on how many of their drugs that are approved were developed in-house versus external. And I remember, so this information is probably 6 years old, but I remember Pfizer was almost a 50-50 split. One of the
Mm,
most common acquirers. Some of the drugs were developed internally, half were developed externally. And so it's that important because sometimes there could be some other drug. As soon as you put something in a human being, despite our best models and effort and de risking, you don't know sometimes how it'll act. There have been a few drugs that have hit that we never thought would hit in the way that they did. Or the idea that GLP 1s could have impact outside of metabolic dysfunction or metabolic indications. So, candidly, FGF21, I was bearish on it for years because that particular mechanism as FGF21 analogs, it's a non-specific catabolic effect. And Pfizer had some papers out there suggesting that it would melt your bones. And so I was thinking about postmenopausal women who might be on that drug but have MASH. What does that mean for them? Well, that signal hasn't showed up yet. So I was frankly wrong, as were some of my peers who were also bearish on FGF21. I wasn't alone, certainly. But you just don't know until the drug is put in and we do our testing and let some longitudinal periods of evaluation pass until we see how the drugs function. And so that's part of it as well. I don't mean to talk about our old podcast as if I'm advertising for ourselves, but it's another reminder on how challenging the space is. That's why I think, Shivu, to some extent, people are never satisfied with enough M&A
yeah.
because, oh, you have that in house. What's the next thing? Because someone else is going to compete with you in that space.
Yeah, 100%. I think internally, there's probably, just coming from our perspective, which is an insider perspective, internally, it feels like sometimes there is a cap to how much M&A you can do, because I think people forget, when just pure acquisitions, right? A lot goes into them. It's a lot of effort to get a whole team together, analyze a company, figure out, what the right price is, go through those negotiations. It takes, sometimes years to close something like that. But the hard work comes after that too, integrating the employees into the company, figuring out the additional investment that you need to run the more expanded clinical development plan for a new asset coming in. And it's a lot of, I mean, to remember, it's a lot of work too. There's a lot of employees that, are on the back end of that have to kind of take the baton and run with it. So there, you do run into, some bandwidth constraints. The other point that I'll bring up is that, just for, the less initiated audience, the big companies sort of think about this like hedge funds a little bit. You create a portfolio of bets, right? There's a portfolio strategy, which is partly your own assets and the programs and ideas that you fund from your own scientists in-house. And then there's a certain aside for all the interesting innovation happening outside of your walls. And you kind of take a portfolio approach, right? There's certain verticals that you're really interested in pursuing, and you might have 10 or 15 different assets, both internally as well as through partnerships, in areas that you're interested in. There's always like a small sliver of bets that go into asymmetric areas, right? So, in the example Kenny gave, FGF21, right? Internally, maybe a pharma goes, we don't really think this target is that interesting. We don't want to work on this ourselves. But in the event we're wrong, maybe we'll do an FGF21 deal, like a small partnership somewhere so that if we're wrong and it hits, maybe that's something that is advantageous for us later on. So it's about creating a portfolio of bets. Drug development is so hard, right? You have like a 1% chance of a drug, being successful. And so if you just put all your eggs into a 1% basket, there would be no industry whatsoever, right? Pretty much every single drug would fail. But if distribute that 1% across like hundreds of different bets, the chances one or two of them hit are significantly greater.
Yeah, I think that's right. You can look at it through the financial lens, which I think is a good way. How many times have we heard an investor say, "Oh, I was long this position and I believed in it," but they would put some options around it, maybe some puts or something like that. And the idea was, well, if you're long plain vanilla equities, maybe a position that's your core, maybe if you're worried about one particular event, but long term you're not, you could have some downside protection by having puts. It's kind of like that, Shoe. That's kind of what you're alluding to. That, okay, well, we have a few shots on goal. If I'm Novo, I'm really good at metabolic disease. So I'm second now, but I'm really good at metabolic disease. Some extensions of that are liver disease. It's an expression of metabolic disease that has gone too far. And so I think that's a good way to look at it. And the trends that we're trying to show, I think you're going to put up a bar graph soon. If we could put that up, maybe it can start to show what some companies are doing in this space. And this is where my soliloquy on CVRs comes back. And I wanted to highlight a few things as well and see your thoughts.
Yeah, let me pull that up right now. I thought maybe we can just start actually on kind of overall what's happening, right? The overall deal volume from the top companies in the space, as Kenny kind of teed up. These are the typical acquirers, right? So again, these are the biggest names in our space, like J&J, Lilly, Merck, Pfizer, et cetera, et cetera. So I don't know, maybe this is a good place to start, and then we can get into the CVR analysis.
Yeah, I think it's good. So Shiv, you did a good job putting trend in there. You see that actually trend is increasing. We have the last 10 years. And if you think about the last 10 years, my gosh, how much have things changed? I think about 10 years ago was right around that time that bar was there was maybe 2014, 2015 was the Hillary tweet, Valiant and Turing. That all happened around that time, by the way.
Yeah.
So
Yeah.
this reminds you how much can change in 10 years. But specifically over the last few years, what you see is a rising trend in the amount of deal volume. And notably, and I think we're both surprised to some extent because there's been an uptick over the last few weeks, right, or a few months regarding how much M&A there's been in biopharma, but we're actually below the last couple years. And so we have 6 weeks left, albeit some significant holiday periods coming up, but we're actually still below trend over the last couple of years and are matching what we were maybe 5, 6 years ago. And so I do think this is a good framing slide that things seem active, but actually we're right around where we should be or maybe a little below.
Yeah, and it's moving up. Like you said, that we haven't finished out the year either. But I think, it's hard to look at it. I always try and look at it in like chunks, right? So if we look at it in chunks of, let's say, like 3 years, like over the last 3 years from 23 to 25, we are seeing a nice little uptick compared to, the dark days of the sector in 2021, 2022, which was, when a lot of things weren't getting funded and companies were closing down, a lot of layoffs, unfortunately. And so things are starting to pick back up. And it's important because everything is connected in our sector. The more exits there are, like the more of these M&A transactions, the more that frees up capital to get reinvested into new ideas, new companies, and that replenishes kind of the portfolio of new ideas that have a chance to make it to the clinic, and then those get acquired. So it's a nice little circle that happens that continues to spur new innovation. So that's why we look at this type of stuff. Like that's why this metric is important.
Yes. I think this is a
So should
great
we go to the
starting frame.
CVR component?
Yeah, let's do that because I wanted to just remind folks about what they could mean from what we're seeing. And so this is CVR usage trends, and this is big pharma only. So Shivu, if I have it right, GenMab's acquisition of Maris probably wouldn't make it in this cut.
Yeah,
GenMab's not.
excluded from this. Yeah.
Yeah,
But
so
we'll
we
talk
have
about
some.
that because it's interesting.
Yeah, we have Big Pharma listed there, some of them, and Vertex does make it in there as well, given their size. They've done so well over the past 5 to 10 years. But what you see is actually the CVR utilization was flat, maybe through 2022 over the last 10 years. And we have the percents there. It's like 12, 13% overall of the total M&A deals have CVRs attached to them. And it kind of it plateaus for a bit. And then there's this huge spike, 23, 24, 25. And it seems to be that we're at all-time highs in 2025. So what did we show you on the first slide? We showed you that deal value, or deal volume rather, is actually a little lower despite it recent activity than what you'd expect for 2025. Again, we have 6 weeks left. Let's see how things go. However, despite being lower, there seems to be more CVR activity from big pharma. So first few things, Shivu, you and I were thinking about, maybe, does this mean that pharma is looking at risk a bit differently now? Where instead of paying everything up front, we can go back to the Novo Acaro deal. They'd rather hedge some of their costs and not pay everything up front and then have that as a liability in the future, where if that study gets approved, I think it was 2031, we said, they'll owe another $6 US per share. That could give a really interesting sign on risk. There's been some other trends as well of non-pharma, non-biopharma entities who come in and essentially do royalty arrangements off of revenue, where maybe a pharma company will get a payment up front for future revenue on an asset that analysts believe has significant potential. That's another way for a company who owns something to get a payment up front and free up their cash, and free up some cash to give them more room to operate at the moment, knowing that they might have to pay some out in the future. And so there's been a few of those as well. And I put all this in the same category, Shivu. I'm curious to your thoughts. It seems like big pharma is taking certain steps to mitigate their risk right now. They'll do acquisitions, they're acquisitive, they're thirsty. However, these huge upfront payments right now, maybe that's not what's optimal for them. You could say that it's a function of rates being a little higher. You could say drug pricing risk is getting considerably worse, so they have to manage things a bit differently. You could say in general, just the recent risk of the FDA and the overall healthcare administration of the HHS is introducing risk for players in the industry. There's a lot of reasons you could say that, but it could also mean that, frankly, maybe they're just really in an acquisitive period, and this is not the end of deals. Merck has been very active this year. Novartis has been very active. So I'll pause there. I'm curious what you think about this uptick in CVRs.
I'm happy that the data bore this out because it certainly feels that way. Just maybe backtracking a little bit, two things to note for the audience. So when we're talking about the overall deal volume, we're just talking about acquisitions. There's obviously been, tons of partnerships and other types of transactions as
Good
well.
caveat.
Yeah, and then specifically with CVRs, I'm really pleased that the data bore out. Things feel a certain way, and you look at the data, and it doesn't make a ton of sense. It doesn't line up with it, but this does. So a third basically of the acquisitions that we've seen in 2025 from big pharma companies all include a CVR, and I agree with you. I think I'm curious how you feel about this, but I've always felt there's like a sweet spot for M&A in terms of like what stage of development. And I think even I think I think Cowen may have done this analysis a long time ago. I don't know if they've updated it or not, but they basically kind of the end of their analysis basically just said, the sweet spot in terms of just like the ROI that you get on your acquisition sort of happens in this like phase one, phase two, proof of concept, post proof of concept type of stage, like pre-pivotal, definitely like pre-commercial. And so, something to keep in mind is like the later stage the company is in, the higher the premium typically is, or the higher the value is. So, something like the Novartis deal that they did with Avidity for like $12 billion. That was a pretty late stage company. I think they had multiple phase three programs, if I'm remembering correctly. And so the value tends to go up, obviously, as you get closer and closer to commercialization. There's less risk in the asset as well. And so I think what we were noticing from this data too is that the CVRs are happening in that sweet spot as well, like that phase one data is already available, proof of concept. Phase two data is already available, proof of concept. And the CVR is kind of getting attached to that. Versus as you start to move a little bit later, you start to see a reduction in the amount of CVR usage. And again, some companies, like we were saying, in 2020, I don't think Merck has done a single deal with a CVR. We can look back at the data and confirm that. But so some companies do them, some companies just don't do them, and it is dependent on what individual situation that company is in. But um, I think that's very logical in some ways, right? With the risk environment that's there, why, from the big pharma perspective, why pay for potential, right? You can pay into the potential. This is the amount of risk that we're comfortable with. Maybe like you're saying, to bridge this valuation gap. Maybe this smaller company thinks we're worth 10 billion, but we think you're at 7 billion right now. Let's build into that remaining 3 billion if we hit X, Y, and Z metrics. And that seems to be more of fashion today than it was previously, for sure.
I think that's generally right. However, because we talked about MASH, I did want to mention Akero's pretty late stage. That I think what's nuanced in what you're saying is I generally, Shiva, I think you're correct. However, MASH is a little different. It's like a cardiovascular outcome study. I'm a anti-cholesterol medicine. I'm an antihypertensive, and I'm going to show that people have less heart attacks and less deaths on my medicine. Well, that takes 7 to 10 years. That's an outcome study. It's one thing to show that I reduced your cholesterol, but do we really care about cholesterol levels? No, we care about what cholesterol does to you over time. That's what we
Mm.
care about, cholesterol levels. And over time is the outcome. So MASH drugs have these outcome studies. You have to prove that on this drug you have less liver events, i.e., less liver failure, things like that. And so the MASH drugs, I noticed all three while you were scrolling have CVRs attached. And I didn't look at the other two, 89 Bio and Boston. I didn't look at those two, but obviously looking at Akero, that was tethered to the outcome study. So that's a scenario where it's a bit different in that you have a late stage asset, but they're not across that finish line. And so I think what you're saying is generally true, that the later stage ones are on the cusp of that finish line. And so acquirers like, okay, I don't need to assign a CVR to this, but ultimate approval is what matters most. However, it's still most of it. Look at the CVRs. It was almost for each of them 10% of total deal value. So I think that's generally right. When you're late stage, you don't need to assign that. You don't have that same kind of risk. But there are some caveats. However, the deal sizes aren't really the shifted in that significantly.
I think that's an important point. Like, some of that is regulatory risk, right? Like, there's outcomes part is particularly important for reimbursement. So there's like a reimbursement risk as well. So all the CVRs really are doing are pricing in that risk into the overall deal, right? And again, as we were saying, like, the environment, dictates some of that. So I mean, should we maybe talk about like this buyers sellers dynamic now,
Yeah, I think that's a
in what
great
we're kind
time.
of seeing? I think my conclusion from this, right, is that like it's great that we're seeing more deals. I think it's better for everybody in the sector. The inclusion of CVRs in this much frequency, especially from the deals that we're seeing with big pharma players, gives me the sense overall. Again, overall, obviously there's going to be situational differences depending on, company, depending on the company, the buyer or the seller, that we're kind of more in this buyer's market in a lot of ways, right? Especially if that buyer syndicate is this group of big pharma acquirers, big biopharma acquirers. It feels a lot more like, hey, we are in this buyer's market at the moment.
I think that's a good way to look at it. At first, you could argue if they're assigning all the CVRs, if I'm a target, I want all the money up front. I want it now. And that's it. That's the end of it. Why would I want a CVR? I don't want to wait for something. I believe in this. That's why I'm here. That's why I'm running this company and doing what I'm trying to do on behalf of patients. At first, it seems like, oh, is it just maybe things aren't as competitive? No, I think the best way to look at it is buyers or sellers market, like you said about real estate to some extent. I think that's a good way to consider it. I think in this situation, like you were saying, it more CVRs lends to the idea that it's more of a buyer's market, and it's been tough for biotech for a while now. So that makes sense. And so you can still have a competitive process. Maybe two acquirers are in conversation with you as a target company, but they're both slapping CVRs on there, and it's debate as to the tail value. That's another way of thinking about a CVR, is how much tail value do you want to assign to this? So I like that way of thinking about it, and I think that's bearing out to the truth that it's a buyer's market. And go back to that first slide we put up, Shibu, that we're still not at full trend for where we should be for pharma deal volume. And I think that also tells you a little bit that it's very much a seller's market,
Yeah, I
buyer's
think
market. Pardon me.
buyer's market. Yeah, yeah.
Yeah.
No, I think that's a great point. I think it's also important to note that like we were kind of digging into this a little bit more for our prep, but the CVRs like are not always don't always need to be a biomarker of it being like tough times, right? Or, that hey, small companies have less leverage, right? There could be situations, right, where it's a seller's market, or in very specific circumstances, it's a very competitive process, and a big acquirer uses a CVR as that sweetener, to go, hey, there's a bunch of bids that came in at 10 billion. Let's do like 10 plus two, and then that's kind of the thing that gets you over the hump. I mean, the deal that always sticks out to me when I think like the first time in my career when I had to look up what a CVR was and do some research on it was when Juno got acquired by Celgene, and they got acquired probably for a total value of like 10 billion, I want to say. Celgene had already owned like a billion of the company. But I think it was either the BMS Celgene acquisition or the Celgene acquired by Juno acquisition where there was a CVR component to it, right? And it didn't end up panning out. The acquiring company, just couldn't meet the CVR deadlines. And typically these CVRs too, some of them will have time frames on them. Hey, we need to get regulatory approval for X asset by, end of this year in order for the CVR to convey the additional payment to convey. And it was kind of the first example I remember of a company failing to do that, which, from a strategic perspective, if you're a small company, that's a really important lesson to remember, right? So if these CVRs are increasing in commonality, remember in some ways, you as a small company, as the seller, the CVR is like an investment almost in the acquirer, right? Like let's take, I again, I don't know the ins and outs of the Akiro example, but it's conceivable that a lot of those employees are probably just going to their options will, vest, and they'll kind of get a well-earned payment and, move on to the next company, right? And the big pharma will just take on the asset and start running the remainder of the clinical trials and regulatory interactions and commercialization themselves. It's an important point because that those individuals that you're getting acquired by are the ones who are their effort, their strategy, their tactics are what's going to make or break whether you hit those CVR milestones or not. So as a small company, you really have to be thoughtful about who your acquirer is. It's not just, hey, this is the price, right? If it's just, a straight, there's a straight deal, just all cash up front, you know, you should still probably think about who the acquirer is, but that's more from like, hey, how many patients who's the right partner that can get this to the most patients and do the most good for humanity with this drug. But ultimately, like if you're weighing 11 billion versus 12 billion, like, most of your investors are going to say, hey, like 12 is bigger than 11. Let's go with that. Right. But if you're using a CVR, right, you have to also think about what is the risk that this company that is buying you fails to meet these CVR objectives, right? Are they a company that, has experience in this space? Do they have a strong sales force? Do they have the right, regulatory people that can get this over the finish line? I think we were joking about this before, but like if you're an oncology company, do you want to do a CVR, get acquired and, do a CVR deal with, someone who's not like a big oncology player, like let's say GSK, who's kind of like wound down a lot of their oncology operations, or would you want to go with like a Merck or a BMS, right? I mean, I think those types of things you have to have a lot of thought put behind them for the seller.
Yeah, I think it's a good point. There are interesting incentives in that. To your point, if I am being forced to take the tail value, the last 10% of this deal is in a CVR, well, it's like, are you going to execute so that achieve that? Because let's say go back to Caro Novo, that event based study outcomes. is potentially 6 years away. So, or maybe even just 5 at this point. Many of those Akero employees will not be around. It is very common that small biotech professionals have de minimis interest working in pharma. So they might help with the transition, especially if I've seen some people who stick around for an approval that's on the horizon. They might stick around because an approval means so much to us. And I've seen people who talk about a certain drug getting approved years ago as still being one of the most momentous periods in their life. So, unless something like that's on the horizon, many don't want to stick around because the innovation flavors are very different in big pharma versus biotech. And many biotechs are built off of that. So, it's really interesting. Will you execute on this behalf? I think also when you go back to the Novo Acaro deal, Novo wants that drug approved. So given what they
Big. I
have in
mean,
their
it's so adjacent to GLP-1s, right? I mean, I think it's such a natural fit with where their
absolutely.
bread and butter is.
And can you imagine, assuming it is positive? I have no insight. I don't know anyone there, but assuming it is positive, what that means for a MASH patient, that I'm not necessarily staring down a liver transplant or liver failure as in potential death. That actually, if I have this issue, and there are some who are genetically predisposed to MASH, I have some reason to have hope. And then there's 2 others who could be somewhat nuanced in their data as well, because they are engineered. Those molecules are each engineered a little bit differently. So those companies are also incentivized to get that done. But you're right. I want to work with someone, if I'm a Caro, who has a history in either liver or metabolic dysfunction. Well, Novo's one of the best for that. And they have been expressing interest as we learn more about GLP-1s and their broad pleiotropic impact, there's been more interest from Novo and other players like, oh, maybe we should try this. And Novo has a huge Alzheimer's disease study readout, I think, on the horizon, Evoke and
Yeah,
Evoke
anytime
Plus.
now.
Yeah. So I think that's an interesting point that I hadn't considered at first. You always want the drug to go in a good place. If you remember, we interviewed Sujal of CymaBay. I don't believe CymaBay had a CVR. I don't believe.
I think so.
But it made sense for him because he knew the machinery of Gilead, so much of it was in and is in liver. And he knew instantly they would reach more patients more quickly. That was the top of his calculus. And so that doesn't have a CVR, but it's also when you talk about the considerations of who's going to take my asset and get it to patients, that was essentially a slam dunk for them. I suspect, knowing the great character of some of those people at Sima Bay, it was probably less about the dollars, more about how can we get it to people as quickly as possible. This is a rare disease. This is not one of those big indications. So another consideration as well: do they have the machinery to take this where it needs?
Yeah. And I think too, I mean, maybe now is a good time to talk about the GenMab example, because I think it's an interesting contrast with what we've seen with how the big pharmas have operated. If you look at kind of the delta between deals this year that were big pharmas that use CVRs. Remember, 30, that's about a third. The baseline overall for the entire data set's probably somewhere around like 20% or so. So it's a pretty significant bump, 13%, right? GenMab, though, I mean, acquired, did
Maris.
an acquisition for $8 billion, which isn't, which isn't nothing. 8 billion is like a pretty significant amount of money. And that's sort of like a big pharma level acquisition, right? In that like kind of 8 to 10 range. They're a mid-sized company. They'd always had this reputation as being more of this like antibody antibody partner of choice, as opposed to like a company that's developing and commercializing their own drugs. But that's been a shift over the last few years for them. They've done a couple other acquisitions for like an ADC as well. But 8 billion was pretty significant. I think they even had to raise some debt in order to do that. I mean, they're kind of in an interesting place, right? Because they have kind of a nice royalty stream from Darzalex from J&J as well, which is one of the best-selling multiple myeloma drugs. But I found it interesting because especially in this environment where you have more of these companies doing CVRs, they strike me as someone who's like an atypical acquirer, especially for that level, for that dollar amount. So going in and buying Maris for that much money was pretty significant. And I think it just kind of shows maybe like the leverage that some of the bigger companies have in this space, right? Where they can since they are bigger, they're a little bit more immune to some of the more, macro things in some ways. They have more cash, right? There's more options for them. There's a leverage. It smells like there's sort of like a leverage that they have that they can use to implement more of these CVRs versus being sort of this like a more atypical acquirer. Like, how do you get a deal done, right? Like, let's just put everything up front. Let's do 8 billion and, call it a day. And I think it's a pretty I mean, just from a GenMab perspective, I think it's a pretty transformational acquisition for them, right? It's a big flag that they're planting saying like, hey, we're going to do our own thing now too. We're going to be a commercial oncology company and not just let's partner and license things out kind of thing. But yeah, curious what you think about that. I mean, like obviously like the presence and absence of CVRs can mean a lot of things, but I think like in that one example where it's not your typical acquirer, like maybe you don't have as much leverage to fight for a CVR in a deal like that.
That could be the case. I also think about how good Maris's data looked in head and neck. And I think to some extent, GenMab is like, by the way, I thought Maris, if it did get acquired at some point, it would have been by big pharma because to
Yeah,
some
me too.
extent, head and neck cancer, I just thought that made sense given some of the indications that we've seen in a immune checkpoint blockade. I just thought it made sense for that. So GenMab coming in was a bit of a surprise, but I think GenMab is looking to be potentially maybe a small cap pharma at some point. Otherwise, why else would you make a play on Maris? I haven't spent that much time in head and neck, but my understanding is there are two players that look pretty decent in terms of where pipelines are, and there's another one after, I think, by Cara as well. And Maris is by far the lead and has been getting credit for their head and neck data for at least a year or two. So I don't know. I just think this is a play from a company like GenMab who just wants to get in, will do what it can to have a tentpole position. And
Hmm.
they've done some clever things over there at GenMab. So I kind of put this in that category and whatever they can to get the deal done. A smaller company will have to raise debt or issue capital, and investors may not like the capital situation, especially if you're revenue generating. So debt probably made sense to them.
Yeah, I think it was really bold. I mean, it's clear they have a vision for what they want their company to be. They kind of want, like you're saying, want to be like a small pharma in some ways, kind of be in the, kind of like Argenx or Beijing or, kind of one of
Yes.
these companies that's like hyper specialized in one particular TA and also has like an anchor in like one type of, I mean, Argenx is a good example of it, but like, hey, let's own one area of the TA spectrum and be a, full stack player in that space. I mean, I think even a company, like Alnylam is sort of like in that territory, right? Alnylam's like, I looked at it the other day. They're like about the same size as Regeneron, which is kind of crazy, which is not. I mean, I think it's Alnylam's like just done such a great job. I think commercially and clinically as well, and Regeneron sort of started to fall a little bit, but they're also a very strong company and I'm sure will bounce back. But it just puts into perspective like how that this biotech middle class, so to speak, is kind of what I call it, is kind of growing, right? There's these like if you look at, the big pharmas as heavyweights, these are kind of like there's a growing class of these sort of welterweights. And I think that are a little bit too big to be acquired, right? You'd have to take these guys out for like anywhere between 40 and 70 billion dollars, which is like not something that one of these big pharmas really wants to do. Typically these massive deals are net negatives overall. And so I think we could start to revert back to this era, interestingly enough, where we do have some of this like more pretty heftily sized but specialized commercial players in this space, kind of like what like Gilead and Biogen and Regeneron used to be, right? Way back when, where like Gilead was this HIV, HCV company, Biogen was this like, we just do multiple sclerosis type of company. And Regeneron was just like the Eylea kind of company, right? Like way back, Celgene too. We were just like a multiple myeloma sort of company, right? So back in, 10, 15 years ago where you had this kind of middle class of players. So it seems like we're maybe swinging back to seeing more of those types of companies now.
I wouldn't be surprised at that. And to your point, the GenMab deal was really interesting. Maybe they are trying to get into that, I guess, middle class biopharma space. Because even Vertex, we had it as one of our listed pharma. I still don't think of them as pharma. It's their
Yeah,
size.
me neither.
I think they still think like a biotech. At least they try to. what I think is interesting about the middle class, which is an interesting phrase you use for this, specific to this, the innovation is very difficult. You and I have both lived through as a company gets bigger. There's just a mass and inertia that makes the concept of chasing novel ideas, i.e., greater risk,
Hmm.
much less appetizing to bigger companies. But smaller orgs, the good ones, ideally, have that appetite, that risk tolerance. And so maybe in that middle class group, it's a little easier to do. One of my favorite companies, some of it's because I'm from the Midwest, is Lilly. Not
Yeah.
just because they've done well, but Lilly was a heavy recruiter at my undergrad. And so I've always been very aware that it's one of the top employers in my home state as well. I've always been a fan of them and their history and their legacy. I know no company's perfect, but they've been doing well for a while. And there's a part of me that wonders as it's definitely becoming the biggest in our space and could be the first to hit a trillion, which is a milestone for our industry. I think it's just short of that now, maybe 10% or so. Are they going to be able to keep this up? Not so much that they've just done well. I'm sure some of their other drugs will continue to do well. I know they're in CNS. I know they're in oncology. Of course, everybody knows them for metabolic.
Yeah.
But the idea that you can continue to innovate when you have that kind of mass. So I don't have their employee headcount at my fingertips right now, but when you get to that size, it is common for companies to hire and to beef up and to do things that pulls away from the success of what brought them to where they are today. Happens all the time. So I wonder if this middle class has that advantage. They're not quite
Hmm.
that massive yet, where the inertia weighs them down, but they still have some of that small company mindset plus the cash flow durability and profitability that you need to kind of fund ideas. So maybe that's some of the secret sauce of why the middle class is doing so well. And I still put Vertex in that class. It's just that they're so much bigger now. It's hard
Yeah.
to based off market cap. But if you look at their pipeline and cystic fibrosis is still I think the core of who they are. It's not big pharma level revenues, but the company's done so well, they're kind of there now by size.
Yeah. Yeah. I think it's a culture thing. You have to retain that culture of innovation. And there's always a balance, right? Like, I remember while we were at Gilead, it always felt like we were understaffed, like we were I think like to put into perspective, like when we were on the CI team there, each of us was leading an entire TA ourselves, which was and didn't have any direct reports or anything like that. And like over time, we were able to gradually expand the footprint of that organization and right size it. But that happened like across the entire company. And so there's with more people oftentimes comes like more bureaucracy, and bureaucracy can kind of slow things down. And so it's always a question, like, how do you maintain that process? How do you create a process that is like pro innovation and speed and creativity? And so yeah, it'd be interesting to see if they continue. I mean, most likely, these at some point, like all these companies are going to dip a little bit and bounce back up. I think Regeneron's kind of like in this downslope, but I don't think anyone sits there and looks at them and goes, "Hey, they don't know what they're doing." Like they're a company with a really strong platform and technology and an ability to make, great drugs. And I'm sure they'll, bounce back at some point, right? So companies go through this cycle, but yeah, I'm really curious. I think it's healthy for our sector to have kind of more of this welterweight, middle class, whatever you want to call it, right? Because those are potential acquirers now, as GenMab has shown, right? Alnylam can go out and do deals, or even some of these companies like in their space, right? Like their size, like Argenx and Beijing and or B1, I guess they're called now, can do maybe even opt in to do some of these sort of like royalty transactions, like you said, right? Like that people have done. I mean, there's a whole set of companies that's their whole business, right? Like Royalty Pharma's one. I think Zoma is another
Mm.
one where they just buy royalty revenues. They'll trade cash up front for long-term revenues on something. And it's really just a put it into this Excel model, and this is the return that will get spit out for it kind of thing. But I mean, there's even more options now for that middle welterweight class, that maybe might be earlier in their revenue cycle. If they did need to unlock more capital, there's options there, right? To do that now. So I think it's good. I mean, we need a healthy sort of, it can't just be the top 15, 16 or so of these big pharma companies that are the ones everybody is doing all the M&A, right? Like if we have more of those, I think it's helpful, which is good to see. I think we need a healthy equilibrium of buyers and sellers.
Yeah. I I I have to just go back to this because it brings back such memories. When we were at Gilead, they were at 24 billion in revenue and had 9,000 employees around the
Yeah,
time we were there, which is pretty crazy if you think about it. Normally, you need a lot more. By the time
yeah.
I left, it more than doubled to 19,000 employees. The revenue didn't change much. I think it might have dipped a little bit. I remember how thinly staffed we were because we were so empowered to chase science. And there was an onus on us. You remember this mentality they had, and we're not over indexing on Gilead. What we're trying to do is share our experience at a biotech that grew but still thought small.
Mhm.
When there were data announced, I remember walking through the halls, and if I didn't have an opinion formed from data that morning, which could be less than an hour prior, there was a feeling your job was at risk. It was that aggressive. And another point to highlight how aggressive it was, not only were we each in charge of our TAs, which were huge TAs, our manager who ran the team, who I hope could join us someday on this, by the way,
Yeah, we
she
gotta
not
have them on.
yeah, she not only ran the team, but she was in charge of the company's largest TA,
Yeah, she's in charge of HIV.
which by the time
Like
I
she
left
had
the
plenty
company,
of other she had 2 jobs basically.
yeah, and by the time I left, I jokingly told her, by the way, there are 3 people doing your job now, and none of them are managing the team. It
Yeah.
just goes to
Oh,
show,
man.
like, how aggressive it was, but look at the success. And there were some look, every company makes mistakes, but there were rumors, Shivu, that Gilead would track scientists in their PhD programs if they were an antiviral and showed promise because they wanted to hire them. Can you imagine how aggressive a company has to be to look at a candidate long before they finish their dissertation and do further research subsequent to that? But they wanted them because they were prodigious. That was the kind of org it was. And that's hard to maintain as you grow. And we've seen the company's gone through some changes and is very fundamentally, it's just very different now. Um, I think a lot about that welterweight middle class as being so healthy for the sector because it can create so much value. Alnylam, in a lot of ways, is wash, rinse, repeat. RNAi,
Yeah.
I got this hammer. I'm going to hit every target I can on the planet. And they've even done stuff that surprised all of us. Oh, we think hypertension's better as a shot. Well, that's a novel thought because cardiology has only viewed hypertension as something that could be managed orally, pills, unless you had a hypertensive crisis and you're in the ER. It's all pills for the average individual. So they've come in and changed the mindset on some things. Who would know? Who would have known? And they're the lead in that space. And I was doing some work on this. It's interesting now. If you look at long acting injections and hypertension, half of the landscape, actually, pardon me, two-thirds of the landscape is RNAi. So everyone's come in and just copied knocking
Yeah.
down angiotensinogen or comparable pathways. So what the middle class can do is some serious innovation, and I hope they continue to do that. I wanted to ask you, do you think it makes sense now as we think about deals, transactions? This is not necessarily in the middle class, but this is an interesting story that I wish I had popcorn for. Do you want to move into the
Yeah, let's talk about
Metsera
it.
bidding war?
Okay, yeah, let's talk about it. So, if you have lived under a rock for the last month, you probably didn't know what's going on in this. But so basically, obviously, GLP-1s are this huge, huge space, right? It's going to be, it already, if not already, it's going to be the largest drug class, best-selling drug class of all time. Probably in our, I mean, maybe in our lifetime, let's say, science moves quickly. Um, Pfizer, the context here is, Pfizer's obviously like a huge company. They've had their own GLP-1 programs that have all kind of sputtered and failed for, a variety of reasons, most notably kind of safety, tolerability reasons. They've really been hankering to get into the GLP-1 space. And there's so many, I think if you pulled up the pipeline, there's probably like 100 GLP-1 or GLP-1 based sort of obesity plays out there. Metsera was one that was very popular. And I think Metsera too, we don't have to get into it too deeply, but they had a lot of advantages in terms of like being an attractive acquisition opportunity because they had both like long acting injectable as well as oral forms of GLP-1s. They had a whole portfolio of these. They also had multiple mechanisms of action, including amylin, which is like another mechanism that is kind of interesting in obesity and cardiovascular metabolic diseases. And so, to me personally, the future of that space is sort of going to be, moving towards doing combinations, right? You have this GLP-1 backbone that, creates a backbone where you can add other mechanisms of action on top. It's also moving towards, oral drugs as well. So we got injectables that are once weekly, getting long acting injectables, and then, like a pill you can take every day. And this, again, this is, if you've been with us for the beginning of this podcast, this is all stuff we've talked about before. So what happened play by play here in September 21st or so, Pfizer announced that they wanted to acquire Metsera, right? It's about a $4.9 billion, $5 billion, value with a CVR attached to it. So, I think the value was like $47.50 a share plus a CVR that went up to $22.50. And, usually like when an announcement like that happens, that's the end of the story. We go, okay, great. Pfizer came in and took these guys out. I think the total deal value at that time with the CVR might have been like 8 billion, something like that around that. That's less important than kind of what we're going to get into next. Usually nothing happens after that, but obviously there's a delta between like when an agreement is announced and to the time that that acquisition closes, right? You have to go through a regulatory process. The government sort of looks through, all the paperwork and filing and make sure there's nothing kind of shady and fraudulent going on. And eventually, the deal closes. But during that time, there was always this risk of internally we would call it the Interloper, which is kind of be a funny movie to movie name. Someone should make a movie called The Interloper. But basically it's this time frame where another company can come in and go over the top on your bid, right? And put in their own bid for Metsera. And lo and behold, that happened. So Novo, as Kenny was talking about, that did the Akiro deal, is really anchoring and has been anchored in cardiovascular metabolic diseases for many, many, many years, came in and said, hey, we've upped we are trying to acquire Metsera now. They increased their bid. And so this was over kind of the course of September to October, basically. And then they got into this like big legal battle. In October 29, Pfizer, rebuked Novo's bid as being reckless, and they said we're going to sue Novo. And then over the course of like early November, Pfizer files a lawsuit against Novo Nordisk and Metsera as it's a breach of contract and anti-competitive action. And then in November 6th, Novo finally, or I guess during this time frame, right? Metsera is kind of going back and forth with both of these companies, trying to figure out like, hey, do we, which girlfriend do we pick, right? Do we go with this girl or that girl? And each time, each one of these companies is sort of upping their offers. Eventually, they land on this $10 billion total value mark, and then Pfizer matches that $10 billion value. But the interesting part about this is like Metsera's final decision to go with Pfizer, because a report comes out, report comes out maybe a few days ago, say from CNBC, saying that the FTC actually got into contact with Metsera and told them that you might run into some regulatory risks getting acquired by a foreign company. And so it's probably better to take, the Pfizer deal. Uh, and obviously that's like a really simplified way of talking about it. We don't know the exact language they used, et cetera. But, the reporting from the news outlets seemed to heavily suggest that the government kind of, you know, came in and said, hey, it's better for you to go with Pfizer instead of Novo just for, antitrust sort of competitive reasons. And so ultimately now I think, in November 12th or so a couple days ago, Pfizer finalized this deal. Novo said they're no longer going to up their bid. And so it's just a really interesting situation, right? In my career, I've never seen this interloper come about. I can't even remember the last time something like that even happened. It was probably before either of us were, even even had a job. So I found it very interesting for that reason, but also for this government sort of political reason, right? I mean, I think it's pretty clear like Pfizer is very close to the government, very close to the Trump administration. They were the first to jump on to this Trump RX idea. They were the first to kind of offer many of their drugs at this reduced price. I mean, we can get into whether they're actually reducing the price or not, and this 3-year grace period and stuff that they have that's very interesting. But um, suffice it to say, they've made a concerted effort to be in the good graces of the current administration. And it would seem if you're connecting the dots that that relationship benefited them in the end, right? It benefited Metsera obviously because their shareholders and their employees, got to get acquired, get a better valuation overall. Pfizer kind of closing this deal in the end. It's hard for me to look at the play by play of this and connect the dots and not think that that relationship with the current government really helped them. And so it's interesting for them from those two perspectives.
I think it is interesting. It also reminds you how I think of that deal as somewhat a sign of the times for two reasons. One, metabolic disease, as you mentioned, is the biggest or will be. Two, with political shifts. Look at the FTC today versus FTC just a year and a half ago. It's fundamentally different. It's ideally now more business friendly, but as long as you're a continental business, if you're on the other side of some ocean, perhaps not. And so I consider myself in most ideal scenarios a free markets person. That is not free market activity. That's interference. So it's unfortunate for Novo. I think it was Metsera got probably the full deal value one way or another. And in a lot of ways, it benefited them because you have an American company matching a higher price. But I find that that whole story was interesting. I thought Pfizer was really aggressive with the language. It almost told you someone felt spurned. That language was so aggressive, using things like reckless and some of the other phrases that you mentioned. I was read some of
Yeah.
the press releases.
The lawyers
It
probably
almost
loved writing that.
Yeah, it almost the IR team and legal team. I mean, my goodness, I bet you there were debates on that too. But it
Yeah.
almost felt like Pfizer was going to do anything to close that, and they probably pulled on some strings to the White House. You go back to the first Trump administration, Pfizer was the first to respond to that drug pricing request the White House had. And their response was, okay, we won't increase prices for the rest of the year, which I think at that time was maybe 5 to 7 months left in the year. But we want the White House to come to us with a proposal and we'll hold until then. Basically, what they did
Mm.
was they returned serve because the White House, it was Trump's first administration. There were so many things that they were unclear on what to do. So in a lot of ways, you kind of got the feeling Pfizer was going to do anything to make sure this happens. And they have become very close to this current administration. I think you mentioned donations in our previous conversation from the CEO, things like that. Pfizer's very close, and they're considered to have one of the better policy teams, as in people parked in DC. So I just thought that was really interesting. I think it remains to be seen who would be the better commercial partner. There's some things Pfizer does really well with its franchises. There's some things it doesn't do well. I don't know if they're as respected in oncology. Maybe they're more respected in metabolics. It's hard to argue of having a better company for metabolic disease, but in a world where we're walking away from globalization, this is somewhat a sign of the times, like I mentioned. So I thought it
Yeah.
was really interesting. I think you did a great walkthrough. I have a suspicion there's a little more drama probably will unfold from the good investigative journalists in biopharma or Wall Street,
Yeah.
actually, Wall Street Journal, who might dig into this, or maybe even Bloomberg. But it's the dream scenario for our industry. It goes to show that maybe oncology has reached peak with activity, and maybe metabolics and neuro are the next final frontiers, you could say,
Yeah.
which by the way is a good thing. It means the
And I
disease
think
is getting.
that was one of our predictions too, right? Earlier in the year that, we're kind of swinging back to more metabolic and neuro as kind of hotter areas.
Yes, and I think, like I was
Yeah.
saying, I think that's good. There was a time, I remember when I was a kid, HIV was a death sentence, and all HIV medical conferences were huge, like today's ASCO. Not so much anymore.
Yeah.
That's a good thing.
Yeah.
So, as we see these shifts, I think it's a great thing. I heard an opinion from an investor a long time ago. This is kind of off topic, but it's about the idea of deal activity and how players try to enter the space. he thinks drug prices being high is a good thing. And the reason is his argument was if you don't have drugs priced high, why would a pharma company want to invest? Because they won't get a return on it. When you
Mm.
look at Alzheimer's, which at that time had a over 99% failure rate, this is probably about 11 years ago, had about a 99% failure rate. Why would any company go into Alzheimer's disease knowing that they could spend 3 billion and not get anything back for it unless they felt they could price the drug in a way that compensated for that money and that time? Because that's also there's resourcing costs. You could have had that effort spent elsewhere. So I think of all these things as, they sound contentious. They sound, is this really good for the patient? In the long run, I believe it is. Is there a difference between how Pfizer and Novo would commercialize those? Pfizer's gonna squeeze every drop out of that because that company has a lot of pipeline issues, and they're gonna wanna make the best out of it, just like Novo has its own issues. Does it really matter which side of the Atlantic Ocean that drug landed? I don't really think so, but I do think it's good for patients in the long term because it spurns, to your original point back in a previous few moments, the idea of innovation. That capital then flows through to other investors who will be incentivized to continue investing.
I mean, one thing we should think about though is, do you think we'll see more of this interloper behavior now that we've seen an example of it? Or is this just two companies who are really desperate to do something in GLP-1s? Like Pfizer, we already talked about, had their own programs that really sputtered. Novo, has had obviously a history of like creating this class, but has really fallen behind who's done, I think, just like a masterful job with redeploying their capital, risk mitigating risk, like creating successive generations of GLP-1s and GLP-1 based assets, and is the most highest valued company in our sector. Whereas Novo, very famously, like doesn't have a ton, doesn't have that same robustness of their GLP-1 based pipeline. There was that whole issue with how one of their lawyers or one of their people like forgot to file a patent extension or something in Canada, and Ozempic might be generic in Canada next year. And so who's had some of these missteps and is, as someone who's like created this GLP-1 class but has been quickly supplanted by Lilly, probably has like a deep desire to go, hey, we got to do something in this space to reclaim our leadership in this area. Is this just a case of like two companies that really needed a GLP-1 asset, and the juice was worth the squeeze to kind of come in and say, hey, like we think this is worth 10 billion, like match it if you want? Or do we see more of our biggest players like try and outbid one another publicly, whether it's in for a oncology drug or a neuro drug or something else?
I it's a good question. And it's of course hard to call. No one has a crystal ball, but I lean towards it being situational and being Metsera being in the right time at the right place and time. I look, I'm thinking from the investor's perspective of the acquirer. I'm probably not thrilled you're spending more money because you didn't have a good development for certain things. I think Pfizer's had some issues with GLP-1 pills, and you have to go now and spend all this money. Okay, well that better work. And then, oh, you got to spend more because you didn't get it done soon enough or something like that. So I think it would irritate a lot of investors if people start overpaying for things. And also, there's a lot of GLP-1 companies out there. Maybe Metsera, to your point, with amylin and some other things they were doing with their targets and their pipeline were nuanced and better in some ways. But there's a lot of GLP-1 players out there. And so I have to believe this is probably a unique situation. I'd put it right now in the aberration category and not the norm. But I'd be proven wrong if within 2, 3 months or a short time, we see another huge bidding war. Because after a while, at what point would a company engage in lawsuits? Like, did Novo have further action to take against the FTC if they wanted to? Because I'm sure they caught wind of this long before the journalistic editions came out with this news. So could they have taken action? And then that would make the scenarios a little different as well. So overall, I lean towards this being an aberration. I think it's hard to continue. I think it's right time, right place. Good for our sector, and we'll see where things go.
Hey, everybody, just one quick note that we wanted to add as an addendum to this podcast. So, as we were recording, we actually got an answer to this very question that Kenny and I were going back and forth on. Are we going to see more of this interloper behavior from other players? And in fact, Lundbeck actually did the exact same thing with Alkermes. Alkermes had agreed to acquire Avidel, and Lundbeck came in at the 11th hour with their own bid. So I guess to answer our question, yeah, we are starting to see acquirers think about this interloper type behavior. So I think it's a good lesson and something to keep track of moving forward. Just because a deal is closed between big company A and small company B doesn't mean that there's another big company C out there that might swoop in at the last minute and look to look to upgrade the bid. So anyway, back to our regularly scheduled programming in the rest of the pod. I think one implication of this to potentially watch out for, right, is if we do believe that Pfizer's relationship with the administration helped them in this regard, does this incentivize more players to create similar relationships with the government, right? In the event that clearly, I mean, I think the government has signaled they're open for business on a lot of things, right? Like my head, before the transaction closed, my head was going to things like, oh, Novo's from Denmark. Trump really wanted Greenland. Like, is he going to leverage this deal to like go take Greenland and stuff? I mean, it sounds crazy, but I mean, and I think we're in an era that's sort of unprecedented and like, anything can kind of happen. But, I wonder if like at least, this interloper behavior as well as this like relationship with the administration and the potential like leg up that might give in situations that are tense causes other companies to think like, okay, how do we like make inroads at least for the next 3 years? Like, how do we create some inroads that might be advantageous for us later?
It's possible, Shiva, but wouldn't that mean your time horizon's 2 years? Because in the second term, the last year is typically lame duck. So you have basically a 2-year horizon to sidle up to this administration and get what you need done. If that's the case, yes, perhaps. But also, given how some of the voting happened in the early part of November, and there had been attrition on the GOP base, I would be surprised if companies clamored hand and fist to get close to this administration with the idea that things can shift. I mean, the affordability crisis in the US has not gotten better. And my
It has
understanding is
not.
that is what drives all voting on the planet. So, in that scenario, how much would you want to do? I think Pfizer was very early and fast to do what they did, and now they're reaping the
Yeah.
rewards. So, for them, maybe it made sense. But Pfizer's also in an acquisitive period of its tenure, of its corporate history. So, it's possible, anything's possible, but you would have to have it on a 24-month horizon, assuming the last year's lame duck.
It just seems to me though that like you don't need to promise much in order to get a deal with this administration. It seems like and maybe this is, I don't know, people can disagree with me on this, and I'm not like a political expert. I'm just a guy on the internet who, watches the news. It seems like a lot of these deals that are being struck are more about optics than they are about substance. Like they all very strangely have this 3-year grace period, whether it's like the NVIDIA chips sort of deal and like the Intel stuff and all this, like in order to avoid the tariffs, there's always this like 3-year time period, this 3-year grace period. I think even with the drug deals that happened, there was always this 3-year grace period, which is always like very curious to me, which is like, yeah, there's going to be an administrational shift, a potential change in leadership one way or the other, no matter what, in about 3 years time frame. So, some of the promises that some of these companies have to make don't feel all that substantive in some ways. They feel more about optics, but the friction to doing something doesn't seem that high from the outside looking in. But maybe folks who are kind of more in that government policy space in our sector disagree with that.
I would love to have a policy expert on our podcast at some point in the near future. I also would love to have a market access or sometimes
Yeah.
colloquially called pricing expert on the call as well. Some of their insights are so interesting because they're in those conversations. I've always wondered, like, do you have to work in DC if you're in policy for pharma? I would assume perhaps you'd be spending a lot of time there. But yeah, it's really interesting content on how that deal materialized. I always pause when I see anything that opposes free market activity.
Yeah.
However, let's just see how things go. Maybe Shivu, just a quick summary from my end as we wrap up. It seems like, as we discussed, it seems like pharma or the acquisitive players in our space are handling risk a bit differently in that they're not necessarily willing to pay for everything up front. And or additionally, there might be a little bit more excitement towards, oh, if I have a drug that might get approved, maybe I can get some money now for it for future sales revenue in a way that doesn't really impact me considerably in the future, mid-single digit type ranges. However, I get a cash bolus right now to do more activity, which might explain some of the recent activity that we've seen. And then this idea of CVRs as, okay, I want to see certain things happen before I pay the full value. However, if you look at a lot of those CVRs, at least in the MASH space, all of them are around 10%. Some of them were bigger, but those deals were also smaller. So a lot of the nuance I think you shared is valid that when you're later stage, it's unlikely to have that tail value assigned to it unless there's some nuances there. So that's kind of how I think about our conversation. And I thought there were some interesting comments you had on GenMab and the bidding war drama.
I think that's a great summary. And so, just for the audience, like we'll continue to keep track of this space. Obviously, M&A is super important in our sector, and as more trends evolve, I think we'll have future episodes either definitely diving into specific deals, ones that really catch our interest from a sector moving corporate strategy sort of perspective, but also kind of a more 10,000-foot view, looking at trends and what they speak to about the behavior of players in our sector.
I would consider this part one of our M&A deep dives. I think it also would make sense, Shivu, at some point to bring someone on board who has a significant deal sheet, someone who's got a lot of M&A transaction experience. I think some of their experience would be very interesting. You and I know a lot of folks in that space because we work adjacent to them, but that could also provide some insight on what they're seeing actively or what they experienced relative to the trends that we observe.
Definitely. So, look forward to that, everybody. If you haven't yet, please subscribe to Drug Dealing Podcast wherever you get your podcasts. We're everywhere: Spotify, YouTube, Apple, anywhere you get your podcasts, we're there. Please subscribe. It definitely helps us out with our numbers and ability to kind of track our progress and get feedback from you about what you like, what you dislike. We'll include snapshots of all the data that we've looked at in the notes of the podcast, so you can download them and use them for whatever you might like to use them for. Let us know in the comments whether you like this episode or not. What other trends have you seen in the space? What do you think about CVRs? What does this Pfizer, Metsera, Novo triumvirate mean for the sector overall? We'd love to hear your feedback. So let's keep it going. For that, it's Kenny and Shivu out. We'll be back again with episode 8 shortly. So stay tuned, everybody. Thanks for your time.
Thank you, everyone.